Hey, welcome everyone. My name's Tim Racette. I blog over at eminimind.com. And thanks for tuning in today. We've got had a lot of good presenters so far, got a couple more left, and I'm going to be talking about day trading specifically, but everything we're going to go over today is going to relate to Fib retracements. And even though I'll be using day trading examples, you can use the techniques and trail stop approach and everything I'm going to talk about can be applied to different markets and different time frames. So you'll be able to pull something from the presentation, either apply it to your own trading that you're currently doing, or if you're brand new, you'll be able to learn a new strategy that'll help you be able to day trade. And specifically, the futures markets is what I like to day trade. So day trading Fib retracements on the E-mini futures is what we're going to talk about. And let's dive right in. So you're going to learn just a simple trading strategy that you can use for the first 90 minutes of the day, and then you can be done. I like to focus on the morning because that's where most of the volume and trading activity occurs. And when I say morning, I'm talking about the NYSE open. So that's going to be 9:30 Eastern time. But again, you can trade any time of day. It's just a good idea to pick a time window and stick to that consistently. Maybe you can't trade the open, so you're going to focus on the close. This simple strategy will be applicable for really any market and any time frame. The whole goal of all this, before we get into the nuts and bolts, is to free up our time so that we can do the things that we want to do. We want to build this flexibility into our lifestyle so that we have either have the time to spend with family and friends, or don't have to go to an office type job, a 9 to 5 job, or maybe you like your job, but you'd like to trade in addition so that you have a little bit extra income coming in, or something to do in retirement. There's lots of sort of reasons that people turn to trading, but I think the end goal is always the same: to try and free up your time. And the way to free up your time is to kind of become financially free so that you're not tied to some sort of whether it's a job or an income stream. So, and becoming a successful trader can help get you there. So we're going to talk about trading retracements and how you can use them to improve your trading, to kind of put you on a path to becoming successful. So a little bit about me. As I mentioned, my name is Tim Racette. I've been trading for a good 15 years. I started actually with swing trading, and then I turned to day trading, or added in, I should say, day trading a couple years after I had begun swing trading. Whoops. And that was a really nice progression. I know a lot of people turn or get drawn to day trading because you don't have the pattern day trading rule. $25,000 account can seem like a lot for some people just starting out, whereas futures day trading, you don't need that capital up front. But if you get the opportunity to swing trade, it really does help build a good foundation because you're slowing down the process. If you're only looking at daily bars, you're going to be slowing down the thought process. I would do essentially all of my analysis after the market was closed. So then I would come into the new day with my plan. And since I was only looking at daily bars, there really wasn't anything I needed to be overly concerned with intraday, other than putting my orders in and then just managing my stop. So if you're currently day trading, adding in swing trading is a nice pairing, because a lot of times when you have a market that's moving really fast, that makes for good day trading opportunities, more volatility, bigger ranges. And when you have a market that's kind of like we've been in, super tight, uptrend, not a whole lot of volatility, that makes for some really good swing trading opportunities. And typically the day trading, the ranges will be smaller, the moves will be smaller. And so they do make a nice complement to one another. But as I said, I blog over at eMini Mind. I primarily day trade the E-mini futures. And I got started, I'm from the Chicagoland area, so there were lots of opportunities to get introduced to trading and the markets. And I kind of got my start a little bit before 2006, but that's really when I started trading and having access to the Chicago Board of Trade, Mercantile Exchange, Thinkorswim was in Chicago or is still in Chicago. The Infinity Futures is who I was trading with, in addition to using Thinkorswim, and they've since been bought up by NinjaTrader. Actually, most everyone's been bought up by NinjaTrader these days, but trading has definitely been a huge part of my life, and I find that the flexibility that it allows is really invaluable to the lifestyle that I live and that I enjoy. So I did attend Arizona State University, and since coming out to Arizona for school, I moved back for a couple of years, and then now I live in Scottsdale, Arizona for most of the year, and then in the summer I go up to South Dakota for the summers in the Black Hills, and it's a really great lifestyle. There's a lot of fun things out in Scottsdale, and not quite as trading central, so you spend a lot of time, you know, not really talking to other traders. And so these types of environments where whether it's an online kind of conference like this or in-person conference, I find really valuable to be able to mingle with other traders. Actually, my good friend and trading partner actually unfortunately passed away in the spring, really suddenly, and so yeah, I don't have a lot of close colleagues to talk trading with. And if you're, I'm guessing most of you are probably trading by yourselves, or maybe you have a small cohort of friends or one friend that you trade with. And it really is helpful to have a trading buddy or some kind of partner to, go have a beer with at the end of the week or talk about trades each day. It uh, really can shed light on your, I guess the word would be shortcomings or things that you might not be able to see in yourself when you talk to someone else who's looking at, even if it's not the exact same market, just looking at the markets. And you can, just by talking things through, really provide a lot of insight. So kind of a little bit of a tangent there, but something that I found really valuable growing up in, learning to trade, just having that person to be able to chat with. So I've had the pleasure of speaking in a number of these conferences, as well as, traders expos. Like I mentioned, those are great places to meet other traders. Presented at the Chicago Mercantile Exchange and had a whole bunch of articles in Futures Magazine and things like that. So I've been around for quite a long time. I'm not that old, but 15 years is I think you're a little bit more of a seasoned veteran in the trading world for being around that long. So one of the things about trading is people can be drawn to it because it's very exciting or seems very exciting, but the way to really make it a career and be around for the long term is to find a way to make it boring. Find a way to be able to repeat a process day after day that is not that volatile. The market's going to throw you enough curveballs and challenges as it is. So the simpler you can keep your strategy and your charts and your trading screen, the more likely you'll be successful. So outside of trading, I spend most of my time outdoors, and that's another reason I really only like to focus on the first 90 minutes to 2 hours in the morning to trade, just because I like to be outside and moving and doing things. And so I spend a lot of time riding my bike, hiking, doing all kinds of stuff outdoors. So you have probably experienced this, but you might be stuck on something, and whether it's a trading problem or something at your day job, or if you're in college, you're stumped on a question or something. And, or if you're just, have something that's been on your mind, you go outside, you go for a walk, go for a bike ride, you go do something to move your body, even if it's just walking to get the mail at the end of the block. And your brain really, it's working in the background. And so many of my, if you want to call them light bulb moments, have turned on while I'm on a bike ride. and, pull up my phone, put a couple notes in there. Could be, going on a walk, listening to a podcast, or just reading a book, not necessarily trading related, but just when you're reading and away from the screen, it really does a lot to stimulate that creative side of your mind. And so, I spend a lot of time focusing on the mental side, mini mind, half the name is mind. So a lot of the focus in becoming a successful trader is how you frame things and how you take the knowledge that you have and apply it. There's so much out there in terms of trading knowledge, and, YouTube nowadays is absolutely um, flooded with all kinds of videos, some good, a lot of them are junk, but there's just information overload, and being able to sift through that, simplify, and really clarify what you're looking for a trade setup is kind of the starting point. And then mastering the mental side, your emotions, how you handle losses, how you handle, when you have had a couple losses and you are all of a sudden in a winning trade. Do you panic and close it out right away? Or are you able to methodically stick to your exit approach or your trail stop and manage the trade the same way every time? So all of those little things really go a long way. And we'll talk about all of that as well. So that's a little bit about me. Like to spend a lot of time outdoors, like I said, and trading is a great pairing for that, because if you're traveling, as long as you have a good internet connection, you're pretty much able to trade. It's best. I prefer to be plugged in directly to a modem, but occasionally, if I'm on the road, using Wi-Fi is a decent option. So let's start talking about trading specific. So as far as my trading style and routine, as a day trader, I'm really not in a trade for that long. We're talking a couple of minutes up to maybe 20 minutes, a half hour. There's a few setups that may keep me in longer, through the lunch hour. If it's a winning trade already and I'm just trailing my stop, then, I'm just going to trail it as long as it's staying in the trend. And sometimes you do get those all day trends, but for the most part, we're talking a couple of minutes to maybe 10, 12, 15 minutes in a trade, and really less is more. So if we can focus on being clear with what we're looking for, really focus on our mindset side of things, then we can really do a lot in that small window of time. We talked about, getting outside, going for short walks. If you have a losing trade, it's a good practice to get up from your computer, and even if it's just walking into the kitchen and refilling your coffee or tea or whatever, and coming back and sitting back down, kind of doing a physical reset, that can help just kind of prevent the emotions from taking over and going from, getting stopped out in a trade and then wanting to get right back in it right away, just kind of stepping away for 30 seconds or a minute. You're not going to likely miss the next home run trade in that minute. Then I really do find a lot of value in reading, even if it's just reading a page or two to start your morning. That routine, just to kind of get your mind flowing, get the juices, the creative juices flowing. It doesn't have to be anything related to trading, but just to kind of get you in that clear headspace. It's for a lot of people, it's easy to just pick up your phone and, start scrolling and TikTok and all the silly junk that's out there. It's really not doing anything for your trading. And I've never really been a TV watcher or spent a lot of time, glued to screens and things like that. And I really do think that's a huge benefit to anyone who is, learning a new skill. Trading is kind of in its own category, but if we were talking about like entrepreneurs, I mean, in some ways, trading is a bit of an entrepreneurial endeavor, but if you're building a business or growing something where you're not just going into an office, spending your 9 to 5, punching the clock and leaving, you're thinking about this thing that you're building, then spending time away from TV and screens as much as possible is a good idea. So as we mentioned, trading is a means to an end, and the goal is to build that flexibility and to have a kind of freed up lifestyle. And so that's what this morning short time block of trading will allow you to do. So this is the way that I lay out my charts. Now I use Thinkorswim, as I mentioned, but you can use, Ninja or TradeStation, whatever platform. It really doesn't matter. I don't have any complex setup here, and nothing's really proprietary specific to Thinkorswim, but I have just the ticker symbols, indices in the top left, and the futures just below that. In the bottom left, I have a NYSE tick chart. We'll talk a little bit about that at the end, but it's not necessarily, you can trade without it. It's not necessarily required. If you're day trading the ES, the NYSE tick is a very helpful tool. And then in the middle, I kind of toggle between a 1 minute or a 15-minute chart, sometimes the 5-minute chart. And that's just a traditional candlestick chart. And then on the right, I have what's called a tick chart. So instead of a time-based chart, we're looking at number of transactions. So that's going to be kind of the first thing that we'll talk about here. So the tick chart, some of you are familiar with it, but in case you're not, then instead of looking at a time frame like 1 minute, 5 minute, hourly, the tick chart is based on a number of transactions. So a 512 tick chart is 512 transactions, and then the candle closes. Why 512, you ask? There's a lot of different stories, if you will, of how some of these numbers came to be. You'll see 233, 512, 1044. It's very vague. But the idea of, somewhere around 500 transactions to close your candle is a really good way to set things up. The difference between 500 and 512 is not going to be a make or break deal. If you're looking at, TradingView or something, it might have a 500, 1,000 tick, a 2,000 tick, but somewhere in this 500 tick window is a good one for trading the ES or the NQ. And I will say, if you do have questions, or if you're watching live, feel free to drop them in the chat, and I'll do my best to answer them as we go, as opposed to just waiting for all the questions at the end. And one question that we had from the last slide was about the reading the Wall Street Journal before trading. And I find that you don't need to know too much about the fundamentals of what's happening in the economy to be a good trader. There's Wall Street Journal, CNN, Marketplace, a lot of these, business shows or business podcasts can be informative, and it's nice to be, versed on what's happening in the broader economy. But to be a good day trader, you're not necessarily basing the decisions that you're making on anything but the technicals on the chart. So it's a great routine, get the paper, sit and have your coffee, and then come in and check the markets. But you don't need to overwhelm yourself with knowing every news, what's happened overnight and every piece of news and those kind of things. So I like to pay attention to what news announcements are coming out that morning, like what time they're coming out, but the actual, projections and what ends up happening when that news announcement comes out, then I'm just concerned with what is the market's reaction. And I'm still looking at the technical side of things. So like today we had jobless claims before the bell. And then I think it was existing home sales. And that kind of kicked off. And let's see, there was a couple other ones this morning at the top of the hour. And we kind of were down at lows. And then and that kind of kicked off a rally that really changed the tone of the morning. When we gapped down this morning, it was kind of like, oh, we're selling off fairly hard in the first 20 minutes. There were no pullbacks, and then right kind of closing in on that number, we paused and then shot up. So yeah, it's helpful to know a little bit about what's going on, but you don't have to dive too much into it. So, but as far as the tick chart goes, the volume is almost baked into the speed at which the candles form. So if we have a 1 minute chart, candle's going to close every 1 minute. And so the candle is the same duration on the x-axis. Whereas on a tick chart, the 512 tick chart, if you were to look at that at the NYSE open, you could get a candle forming, in a couple seconds. Whereas if you were to look at that same ES chart at the after hours, it might take a couple minutes for a candle to form. So you get a sense of the speed that the market's moving as well, kind of baked into that tick chart. And I wouldn't really call it an indicator. It's just a variation of the time based x-axis, and you're transforming that or switching that over to a transaction-based x-axis. So if you were to look at the chart and take away the x-axis, is a candlestick's going to look just the same as a 5-minute chart. It could be even a daily chart. So then I like to pair that. You've probably noticed if you were looking closely on the bigger chart that I had on my trading screen, I've got something that looks a little bit funny, a little variation, and that's the Heikin Ashi candlestick. And this isn't required, but it does help clean up the tick chart. And so it's similar to a traditional candlestick. So this is what a traditional one would look like. Yours might be just open and filled. Sometimes they're black and white. On Thinkorswim, red and green. And so this would be the traditional candlestick. And then if we compare the exact same chart, only put the Heikin Ashi candle variation on it, it makes it a lot cleaner because it strings together a bunch of trends. And so, you get a string of green candles and then a string of red candles. And instead of each candle beginning where the last candle closed, which is what a typical traditional candlestick chart would be, open, high, low, close, the Heikin Ashi variation starts at the midpoint of the prior candle. So it's midpoint, high, low, close. I'm not really concerned with the shape of a Heikin Ashi candlestick, like if it's a hammer or a spinning top, because the variation is pulling from the middle. And so it's going to give a different shape than a traditional candlestick would. Even if you were on a traditional candlestick on a 512 tick chart, that's such a small time frame, a hammer or various candle patterns, traditional candle patterns are not really very applicable. So, but it does help clean up the chart, especially when you're changing trend, as we're going to talk about here in a minute, can be really helpful. Some of the let's see. Yeah, well, the colors, as far as where some of the benefit to having a cleaner chart is actually not so needed in a trending environment. It's when we get into a range bound situation or a consolidation situation. Because if I were to just show you the chart on the left and ask you what's the trend, well, if you look at the left side of the chart and then you look at the right side of the chart, you can see, okay, we're going up and to the right. Pretty easy to say it's an uptrend. You don't need the Heikin Ashi candlestick to determine that. But if we look at some tighter range bound situations and consolidation, that's when it can be a lot more helpful. Finishing up on the news discussion, the FOMC meeting So every 6 weeks when they have that FOMC meeting, that's actually a day that I prefer not to trade. And same with expiration Friday every quarter. So for futures expiration. So those two situations are days where I purposely take off. Um, if any of if you've looked at the FOMC in the afternoon when the Fed chair will come out and start their public address, you could pick the overall right direction that the market ends up going, but getting there is going to be such a whipsaw that you'll end up with, not just getting stopped out, but having a ton of slippage and then getting back in and then watching the market go the way you want it to and then chasing it and then it sells off and then you get out. And it's just such a whipsaw event that I find it much safer to sit tight and not try to bank on a news announcement like that to be my trading strategy. So when we pair these two, the 512 tick chart and the Heikin Ashi together, you get just a real clean chart that helps you identify the trend changes. So again, traditional candlestick on the left, if we compare that to the Heikin Ashi, the downtrend still pretty easy to see on the traditional candlestick side. The bigger string of red candles really makes it clear on the Heikin Ashi side. But it's when we get into these consolidation pits that we can really see you get a couple of green candles, a couple of red candles, and that's where a big part of the value comes from. So that not only are we looking at basic swing highs and swing lows to determine the trend, but when we are not stringing together big long runs of green candles and big long runs of red candles, it can be a red flag to us that, okay, yep, we are starting to consolidate. And I want to be careful in here, especially if we're stuck in a larger range or stuck inside of the prior day's range. Those are days where you can really get chopped up. And most traders don't necessarily have trouble with not having any winning trades. Like a lot of traders will struggle with not holding on to those winners long enough, but they're able to place a trade that even if they're not in it after 10 or 15 points, they were in it at the start and then just got scared out of the trade or exited for a number of reasons. But had they held on, it would have been a bigger winning trade. But where a lot of people get tripped up is, are the days where there's not much of a trend going on, or we're consolidating, or even today, this morning, I found to be a lot more challenging than, Monday, Tuesday, Wednesday of this week. And it wasn't just 3 perfectly clean trend days either, earlier this week. But, on a day like today, sometimes you start a trend and then that trend falls apart. Then you start a trend in the other direction and we started to rally. And then we broke highs this morning at, 45 minutes into the day or so, and then just kind of fell apart and just started going sideways without any follow through. And those times can be really challenging. If you get chopped up, take a bunch of trades, end up with a whole bunch of stop outs, kind of lose it a little bit on those days. Now you come into Friday and you've got this big hole to just fill back in. This combination, so 512 and Heikin Ashi, is a really good starting point for most of the futures markets, ES, NQ, Dow and Russell, yes, as well. If you put that chart on and you don't see much movement, you can go down to a 233 tick chart. But if you don't see much activity, like you don't see many candles over the course of a day, and you're looking at, some commodity or especially the currencies, it may not be the greatest market to trade. I used to trade the Euro USD 6E futures, and then they changed it to half pips. And then it just kind of really died. And there wasn't much actionable trading activity. I mean, there is some, but not like what it was. And so I just stopped trading it. So you really want to make sure that there's a good amount of activity on the markets. That's why, the ES, and I know a lot of people like the NQ, but man, that thing moves so fast. I mean, it can move fast now, and we're in super low volatility environment. I don't know how, you know, some of these traders can manage a trade on the trade ladder when it goes shooting up from the top of the bottom of the screen to the top of the screen and then shooting back down. The $5 tick value is a little bit more manageable for people, but the ES is really nice because, yeah, it's a little bit bigger tick value, 1250, but it slows it down and it makes the trade ladder much more easy to manage. So the first thing that we'll talk about before we get into kind of the entries and managing the trades and the structure of the trade, or the execution of the trade, first we're going to talk about market structure. So even if you have a strategy that you really like trading right now, it's still important to be able to identify, do we have a trend? Do we not have a trend? And more importantly, as we'll get to, can I identify when that trend is changing? So the basics, like if we were going to preseason football camp, the basics of football, American football, are blocking and tackling for defense. And so we want to be able to master the basics in such a way where we don't have to think about it. And so if we're looking at the basics of market structure, that's going to be made up of, all the emotions that we all know of, fear and greed. And the basic market structure is based on the higher highs and higher lows for an uptrend and lower highs and lower lows for a downtrend. And so just going through the chart and marking up those swing highs and those swing lows is a really good exercise. You can print out a 5-minute chart of the whole day for the ES or the NQ, and just going through and marking the swing highs and the swing lows and relate each high and low to each other is a really good way to kind of build some basic fundamental understanding of the trend. And so when it comes to drawing retracements, I know most people are familiar with Fibonacci retracements, and I don't get overly complicated with all of the different fib levels, but some of the basics of using that Fibonacci retracement tool and applying it to the trend. We always want to be drawing from the left side of the chart to the right. And we want to, I like to have the 50% line on my chart, the 61.8, and then you could call it the 123 or the negative 23.6. Those are kind of my three pillars. The 50% is the halfway point of the pullback, not a fib number, but just a reference point. The 61.8 is a fib number, and that's kind of the failure point in the markets, where if we've gone, if we've pulled back more than 62%, there's a good chance that that trend is going to reverse and continue to go the other way. And then that negative 23.6 is kind of a projected target. So we'll say roughly 25% beyond highs or lows. That's a good projected target. Then this other faint one at the bottom is the negative 61.8. That is kind of a secondary projected future target. Sometimes if we get selling off hard, we'll trade down to that negative 61.8. So the halfway back is what I use for the entry point. And like I said, it's not a fib number, but it's just actually that was derived from the pit traders. We would go, or where I learned it, the floor traders would look at the first hour of the day and then take the halfway back point and use that as their entry into kind of a resumption of the trend after things pulled back. The 61.8 is the failure point, and then the negative 23.6 is the projected target. You don't have to actually have a order there to exit the trade. That's just kind of gives a general idea of what we'd be looking for the market to break lows and continue on, or break highs and continue on from there. So when it comes to drawing the retracements, since we're always drawing from left to right, once we have 2 points and we, anchor our retracement to those 2 points, if we do, in this case, drawing up a short setup, if we do trade away from that 50% and trade down, then once we hit the negative 23, then we can draw the next retracement from where that first 50% was down to that negative 23% target. And in doing so, it kind of creates this next lower low and lower high situation where you're continuing the trend, continuing to trade in the direction of the trend, whether you're getting out at the negative 23 and then re-entering at the 50%, and then getting out the negative 23 and then re-entering at the next 50%. Or what I prefer to do to cut down on my risk is to get in at the 50% and then trail my stop. And so I'm staying in the trade, I'm letting it bounce, and then I'm just trailing my stop either, above the 60-1/8, kind of above that failure point. That's a really good spot. You can also trail it just above the swing highs on the way down. But either approach, the concept of drawing up the fib retracement is kind of the fundamental piece for identifying a trade setup. So when it comes to, so that would be a traditional retracement. And I just wanted to touch briefly on an extension. It's a little bit more of an advanced concept or idea, but you're still drawing from left to right. But instead of doing a high to low, one of the reasons I like to introduce extensions is because it helps clarify the traditional retracement a little bit better, because traditionally we're taking a high point to a low point, waiting for a bounce, getting in on the bounce, and then expecting the trend to roll over and resume, in this case, the down move. Well, sometimes we get a sharp sell-off, or we get a bear flag, or we just take a nosedive and don't bounce very high. And then what you can do is draw an extension, which would mean instead of drawing a high to low, you'd be drawing from a low to low. And then that's going to lower the 50% kind of halfway back point. Then you say, okay, well, how do I know whether I should be drawing a retracement, a traditional one, or an extension? Well, if we go beyond that negative 23.6, that's kind of the expected zone or area where the trade should go. And if we sell off really hard and we go to the negative 60.18 or beyond that, now you have a much better chance of not pulling all the way back to the 50%. And sometimes, if you've been trending down for a while and you've got a 50% and you sell off and you roll over, and you bounce to the 50%, you sell off and roll over. After a while, you're going to break one of those trends, that 60.18, and make a bigger pullback. A lot of times in the futures markets, like an hour into the day, so 10:30 Eastern time, you get a bigger pullback, and then you can draw from the starting high of the day down to the lows of the day and get the full halfway back for kind of a bigger pullback or a reset on the day. So extensions are used in like a really strong market or a really heavy selling market where we're just not making, a bigger retracement. And sometimes it is just too late, and it's better to either take a counter trend trade or wait for that larger retracement for the market to reset a little bit. So when it comes to getting into the trade, we want to wait for a break of the swing high, which If you're in trend, all that's doing is continuing. Okay, we made a higher high and a higher low. We came up and broke and made a new higher high. We're expecting it to pull back and make a higher low. Higher high, higher low, higher high, higher low. Super basic, pretty boring, but that break of the swing high is confirming the continuation in the trend. Now, I purposely cropped the left of the chart here in this way because the left side here, we could actually be in a downtrend coming into this point in the chart, in which case we were in lower high, lower low, lower high, lower low. And at this point where we break the high, we then go from lower highs and lows to higher highs and lows. And so this pullback here becomes, if you draw the 50% retracement, this becomes kind of the earliest point that we could get into the trade if the trend is changing. And that's a really key area when we're breaking a swing high. This is super helpful on a daily chart as well, especially like right now. We've been just months of straight up higher highs, higher lows, higher high, higher low. It's always good to know where is the most recent swing low. And it's, in this case right now, we've got a little hammer from last week. And then about 2-ish weeks ago, there was a little bit bigger pullback on the daily chart. And those are key levels because if we take out a swing low, we now have the potential for a new trend to be starting. So if you're, trading with the trend, that's going to be the most likely place to get momentum. But sometimes we end up in a downtrend, like in a range for the day, let's say, and we go from the 30-minute high and then we sell off to the 30-minute low. And then we go back up to the 30-minute high, like the first 30-minute range, if you will. And then we fall back down to the first 30-minute low. And so rather than trading in the middle of the range, when we're going sideways, we want to be selling at highs and buying at lows. And so I like to just place a limit order at the 50%. Actually, I'll round up to the nearest quarter, half, three-quarter, or even, and then add a tick. So if you're at, an odd number, which most of the time you will be, just rounding up to the nearest tick and then adding a tick so that you get filled. Because if the price typically needs to trade through your order. When it just touches your order and fills you, which happens occasionally, we joke and call that a magic fill. So this is probably the most important piece of everything you would learn today. I know a lot of it's, some review for some people, but the way that I like to manage my trades. So I will start on the ES with a 2-point stop. You could put your stop outside of the 61.8 as well. But 2 points is just, it's nice. You can have a bracket order set up. You get filled with your limit order. Boom, the stop goes out. So the first thing I'll do if it starts moving my way, because, it's easy to have a plan for if things don't go your way, well, your stop gets hit and then the trade's over. Mm-hmm. I always like to go into the trade sort of picturing getting stopped out and kind of accepting that loss already, like it already happened. And then that, you've kind of accepted the worst case scenario, and then any jitters or nerves are already kind of worked out. Then you can focus on managing the trade. It doesn't really happen much anymore. But that idea when I was first starting, I found really helpful, kind of visualizing getting stopped out right away and, having to move on with the loss, and kind of asking myself, okay, am I comfortable with that, with this size of position that I have, or do I need to scale it back? So the first way the trail is behind the next 61.8. So you could just draw up the next retracement in the trend and put your stop behind the 61.8. And then if we continue to trend and continue to go in the direction that I'm in this case long, then I like to just trail the swing lows as we're moving up. And then sometimes, and you can just continue to trail swings all the way. You can do this on a daily chart, intraday chart. Trailing the swings is just a super classic trail stop technique, but it's very simple. But a lot of people aren't able to let the market rally and pull back and just sit tight and not micromanage the trade. Um, Linda Raschke talks a lot about this in her trading over the years. I mean, using this type of trail stop is super effective. And if things do get ripping really fast, like this one, you've got all of these green candles back to back to back in a row. What you can do, so if you were going to trail the swings, you would just put your stop underneath this little one candle pullback, then you rally, and then don't really need to do anything. If we have an inside candle, I just leave it alone. But when we pull back and then make a new high, bring your stop up here to the next white line, and then you pull back and then kind of push up again. You can move your stop up underneath the next swing low. You don't necessarily have to wait for it to make a brand new high. You can wait for it to break the high of the individual candle to call that a swing low. And then that's where you would get stopped out on this particular trade. But sometimes the market rips, and especially to the downside, sometimes I guess about 50-50 happens to the upside too. But more often than not, it's when you're selling off hard that the market is just going down, down, down. In this case, you kind of have all these green candles going up, up, up. And what you can do if all of a sudden things are chugging along kind of slow and then you get a spike, you can just come in and trail each candle. So that way you are locking in your profit. You're not just, capping your gains or throwing a target out there or hitting the flatten button. You're trailing your stop as long as each candle, makes a higher low than the prior candle. And you can just kind of drag it up underneath your candle as best you can. If you're trading on Thinkorswim, then you can manage the trades right from the chart. I use TradeOutLoud. I used Infinity for a long time. Then they were bought up by Ninja, and then they kind of closed the Infinity portion of it. But if you were using TradeOutLoud for charts, the same kind of thing. It kind of links up the charts with the price. But since I use Thinkorswim for charts and TradeOutLoud for my trade ladder, I just manage it on the chart. I'm sorry, on the trade ladder, and just kind of I end up hovering my cursor over the price on the chart, and then just I have my second monitor, my trade ladder is right on the left side of the screen, so I can just pull my mouse over and then click that price and just keep dragging it up. So those are kind of the three trail stop approaches that work super well. The 61.8 is going to be the most conservative, and then we're kind of working to the more aggressive trailing swing highs and lows is a little bit less conservative. It's going to be a little bit tighter stop, and then trailing each candle is going to be the most aggressive. I don't do so these three trail stop methods aren't necessarily based on a fixed trail amount. Like you could set your bracket order to trail the highest, like the best profit in the trade by 2 points. So the max profit in the trade, trailing it by 2 points. That kind of stuff, just based arbitrarily on the price, is going to kick you out of the trades a lot quicker. Whereas if you're using the chart and letting the market dictate when, because remember, breaking a swing low is indicating breaking the trend potentially. So using the chart and letting the market tell me when I should get out, I find to be a lot more effective than, I could set it up based on the average true range or, a whole bunch of factors to kind of auto trail, or, you could have a target out there at just 3-to-1 reward to risk. That's a really effective exercise when you're starting out, and you can trail your stop on the way. So if you have a 2-point stop and a 6-point target, you can trail your stop at the same time that you have this target out there. And then, you're trailing your stop, and then boom, your target gets hit and you're taken out of the trade. As you get into more contracts, it can be a lot easier to do things like that. I've always split my position in half and had a smaller target like that. You could have a 6 point first target and then trail the second half of the position. But really, the value is in trailing and catching those bigger runners. If you trail your stop and you start trailing it, and then okay, it's up half a point, and then your stop is up a point, and then you get taken out, you're going to end up with a handful of small winning trades just by the nature of getting taken out on the trade that doesn't rip. So I don't find it very necessary to have super small profit targets because those small winners are just going to happen in the nature of your trading. Stop outs are going to happen, full stop outs are going to happen, and those small winners are going to happen. So if I can try and maximize my profit on the trade by catching that home run and managing my stop based on the strength of the market at that point, then I can kind of cater my trail stop technique to the market. If the market is screaming and going green candle after green candle, then I can, rather than, let's say the market's up 4 points and it starts to rip, rather than just closing it out wherever I'm at, trailing the trade is going to keep you in a lot longer, and you might walk away with 8 or 9 points before it finally pulls back. And I think most importantly, it gives you something to do that you can prepare for if the market starts what I would call giving you an opportunity with a bigger profit target. You don't want to have your profit target 15 points away from where price is. And so that's where, judging the speed at which the market's currently moving, and then, trailing swing lows. Okay, we're moving it up a couple points at a time. And then, you get these sharp pushes and it shoots up 7 or 8 points. I don't want all of a sudden my stop is 10 or 12 points away. I don't want to leave it that much room to give back. So then I can come in and tighten the stop. So one thing I wanted to talk about that's been happening a lot lately is if you're looking at like a 1 minute chart or looking at multiple kind of what I would call looking at a higher time frame, because a 512 tick chart is going to be really small. If you look at a 1 minute or a 5 minute chart, drawing up your retracement when you get a break of a high of the low bar or low of the high bar on like a 1 minute chart is a really good place to draw your retracement, because you're getting traders looking at the 1 minute chart, and you have a new lower high put in as soon as that candle is broken. And so once a lower high breaks or a higher low breaks, coming in and getting in on the first pullback is, it's almost like you're anticipating the breakdown or the sell-off, and that can work super well. This blue line on my chart is actually a 21 period moving average. I put that on maybe 2 years ago, and I do find it fairly helpful, especially when we retrace to the 21 EMA. In the morning, a lot of times, if we gap, and if you have just the trading hours only on your chart, it'll take 10, 15 minutes for the 21 to catch up. But once we tag up on that 21, it's a great spot to look for a trade. And it's also a very easy way, just like having the Heikin Ashi on the chart, having the 21 makes it very quickly clear. Are we trending or are we moving sideways? I can look at the higher highs and higher lows, lower highs and lower lows, but I can also just verify, okay, is the 21 EMA in a 45-degree angle, kind of indicating that we're in a strong trend, or are we just kind of wallowing sideways? So the last thing I wanted to touch on, the NYSE tick, like I said, you don't have to use this, but it is, if you're trading the ES, I would strongly encourage you to add it, just a small chart, and put it up there for a couple of weeks and just kind of look at it as you're entering the trade. The main idea with the NYSE tick, it's essentially telling you the net number of stocks that are moving up versus down. That's what the readout is. You get a number usually between plus 1,000 and minus 1,000. But you want to be getting long in a relatively low tick and getting short in a relatively high tick. So as the market's pulling back, at that same time, I want to see the NYSE tick pulling back to, doesn't have to be the low tick of the day, but a relatively low tick for the day. And that's a super helpful way to ensure that you're going to get a strong reaction, or very likely get a strong reaction right after you enter the trade. So a few helpful tips. I always start my drawings, my retracement drawings, at the beginning of the market open. So not using the overnight, just that regular trading hours session. If you start to get lost, the 5-minute chart is really good because it can slow things down and be a little bit bigger time frame to help verify the trend. The 512 tick is really good for the E-mini futures. You always want to be drawing left to right. We all, I think, have a pretty good grasp of that, but sometimes it's easy to get lost and not sure. And so just picking like the highest high and starting there. If you miss the open for the morning, that's a good place to start. The lowest low or the highest high. Once you break a 61.8, then we can start to draw in the other direction. Oops. And that 61.8 is a good kind of line in the sand for a failure point. So to kind of summarize the entry and trade management side of things, you don't have to use the Heikin Ashi tick chart combo, but you could just draw retracements on the 1-minute chart, and that works just as well. But I do find that tick chart is a nice variation and a small enough time frame that you can get into some really big moves, before they're as clear on the larger time frames, like a 1 or a 5-minute chart. Starting by identifying the trend, look for that break in the swing highs or swing lows. That would be, what I would call the change in trend. And then trading with the trend is going to be the easiest, most like the highest probability setups. Going counter trend can sometimes be really big moves, but I would encourage you to start with trading with the trend. Getting in at that 50% retracement and then trailing your stop, starting with a 2-point stop on the ES. If you're doing NQ, you could start with a $100 stop, the equivalent. But yeah, ES 2-point stop, and then using the trail stop, either picking one approach and doing that all the time, or starting with the 61.8 as your trail and then tightening it to the swing highs and lows. And then if it really gets taken off, you can trail each candle. So that's the basic gist of how I like to trade the futures markets. If you do have questions, you can always shoot me an email. Happy to chat more. Tim@eminimind.com. I think I hit most of the questions that you had in while we were talking, keeping my eye on that. But thanks for tuning in, everyone. And I appreciate you all, and have a great rest of your day.